Hi, and welcome to our Builder of Choice Insights. I'm so excited to have you here today. We're going to have a great conversation on interest rates, Washington, cost of living, affordability, and regulatory burdens. So many great topics today. And I have my guest here with me, David Battany. He is from Guild Mortgage Company, and I'm going to have him share a little bit about who he is and how long he's been in mortgage and some of the fun things that he has as he was kind of coming through the ranks.
Emma, thank you. It's a pleasure to be here. So I grew up in Colorado. I was actually a volunteer firefighter when I was here. And then years later, I had the ability to defend my own home in 2010 when the Left-Hand Canyon fire burned right through our property. Wow. So that was a very exciting Colorado connection.
Yeah, but, way to experience fire for the first time, right?
Right, seeing it firsthand on your own property. The good thing is we mitigated our property, we thinned our trees, we got all the fuel off the ground, so every square inch burned, but all our trees survived, our house survived. All of our neighbors who didn't mitigate their property, all their trees burned and all their homes burned down. Wow. So mitigation's really important. For fires. But in my career, I worked in California for Fannie Mae most of my career in the Pasadena, Los Angeles area. I was actually a police officer at the same time because mortgages were boring. So I was a police officer in Los Angeles for 32 years. At the same time, I was working in the mortgage world.
I mean, you were fighting fires in Colorado and then doing mortgages in California. You might as well add a little bit of excitement.
Something else to be doing. So I had a lot of interesting backgrounds. I did a lot of volunteer work. I was with Habitat for Humanity as a builder and a board member, rebuilding together as a board member and also as a house captain. So a lot of work with inner city neighborhoods. And I did Operation Santa Claus for 34 years. Mm-hmm. So every kid who writes a letter to the North Pole to Santa Claus, the post office gets that, and the Chamber of Commerce goes out on Christmas Eve and knocks on their doors, and you were there in a Santa Claus outfit delivering toys. I did that for 34 years in Los Angeles. So a lot of different parts and pieces. But in my current role at Guild Mortgage, I'm running capital markets in our product team, but I also do a lot of housing policy work. Mm-hmm. The Mortgage Bankers Association has their Residential Board of Governors. It's our primary policy group. So I was the former chair of that group. I'm currently a board member. So I spent a lot of time in Washington, D.C. I just flew back yesterday. But a lot of time in Washington, D.C., meeting with policymakers, people in Congress, think tanks, government agencies, entities, just trying to help educate, create awareness, try to find solutions for the different challenges we face as an industry. So affordability is very much a top issue in people's minds in Washington.
Oh, I'm sure. Well, and one thing too, just with your experience, I feel like a lot of policymakers don't have a real true understanding of what happens in the home building industry. Like they know how it affects them, but they don't understand the intricacies of our particular industry. Is that something that you've experienced and that's part of your education process?
Yes and yes. It's very accurate. They understand enough, but a lot of times they don't understand the real challenges and what the obstacles and barriers are. And it's part of our job to help educate them to the barriers and issues and help connect the dots so they understand how lack of supply drives home prices going higher. And when we talk about affordable and the affordability issues, it's really a math problem. Mm-hmm. It's the problem of the monthly payment and the problem of the down payment. Yep. And home prices rising faster than people's incomes are rising just makes it harder for first-time home buyers to get into the market. So we talk about just those challenges as first-time home buyers. And there's a lot of things that the government does that can be part of the problem, but also part of the solution. So there's never a lack of things to talk about. There's so much going on.
Well, and one of the things you and I were discussing before was that affordability is, because we were like, well, sometimes when we talk about these things, it could get very political. And we're not here to be political, but affordability is something that's important on both sides of the aisle. Can you share a little bit about your experience? Because I know you're not just talking to Republicans, you're not just talking to Democrats, you are talking to both sides of the aisle. Tell me a little bit about how both sides see this issue.
It's interesting because housing's always been a top priority for people in Congress. And I've been meeting with people in Congress for probably 20 plus years in my career. But the last few years, they're very, very focused, because if you just poll voters in any 50 states, the number one issue, number two issue on their minds is either the cost of housing or the cost of living. And to me, the cost of living is just effectively the cost of housing is a huge part. So it's the point now where they're very interested in having conversations. We'll actually receive invitations to go to Washington to meet with Congress members to give. I've had the privilege of testifying in front of the Senate Banking Committee on housing issues, or actually maybe informal conversations, just helping to educate different issues and just kind of give an honest perspective. Because if you're in Congress, everyone's bending your ear on different issues, and you're hearing different sides of stories. So sometimes it's good just to have a candid conversation about what the real issues are and what the best solutions or the most pragmatic solutions might be.
Yeah. No, that's super important. And it's great to know that that is something that's important in Washington, as well as on the minds of everybody here. Some of the things that go into affordability are obviously the cost of housing has increased significantly, which you mentioned impacts the monthly payment, which is huge, and also the down payment. We were talking about, I think you have kids about my kids' age.
Yes.
And my son's 25. He's, with his girlfriend, they just got an apartment together, and they are talking about, how do we save money to buy a house one day? How do we pay our rent, our monthly rent and our monthly bills, and also put money away and plan for a monthly payment? What are some things that you see as challenging for this new generation that's coming through trying to buy homes?
I think the analogy is like a person standing still and watching a train drive by and trying to catch that moving train. Because once you buy your first house, that's the hardest challenge for most people. So I think once you buy your first house, your future move-up house is not as much of a bite, because if the home prices went up, hopefully your first house has equity. Hopefully your income has gone up over time, and your next house from third and fourth house might be a little bit easier. But it's that first house. Part of it's a psychological barrier of just thinking I can't afford a house.
Right.
Part of it's a simple math barrier, to your point, the down payment or the closing costs, and then there's the monthly payment. So the solutions we try to find, are looking at that math problem, the down payment problem. There's a lot of debate about, should you do a 3% down, or a 2, or a 1, or even a 0 down payment? And the idea is, if you don't have skin in the game, or you're more likely to walk away from the home.
Right.
But the flip of it is, if you require 3% down payment versus a 0, that person can keep that cash that would have gone into a down payment and keep it for reserves for emergencies. So do you want them to have a sort of emotional equity in the property, or actual liquidity, that if they get into trouble, they have cash reserves that they could use? The Federal Reserve did a study. The number of U.S. adults who could get through $1,000 surprise to their balance sheet without having to rack up credit cards or borrow from Tony Soprano, 39% could not do that. So if 39% of adults have less than $1,000 of cash reserves, do you help a first-time home buyer by having less of a down payment requirement and let them keep that cash as reserves?
Yeah.
Does it give you a better outcome? So there's a lot of debate, but there's a lot of focus on lower down payments as solving that part of the problem.
Oh, that would be very helpful for a lot of the young people trying to buy homes today, just because cost of living has become so high. And like you said, salaries hasn't met up to that same level. We've seen charts from John Burns. They do a presentation in all of our builder groups, and it's like salaries are like kind of going like this, and cost of living went like this. Right. And then with the mortgages on top of that, it's even exponentially higher. Tell me some of the things that, as a mortgage, looking from the mortgage perspective, how can that piece help with affordability? And then let's talk a little bit about what you've seen as far as the home builders.
Sure. So as far as the monthly payment, there's different ideas on how to lower that. Certainly people can do ARM loans as one way to do that, but you don't want to be like pre-2008 where people were doing monthly option ARMs. That's not the solution. So there's temporary buy downs, permanent buy downs. Sometimes there's grants for home buyers that can help with some of these that might help take the bite out. And some of it's product innovation. There's two products that we've created. They're sort of innovative products. One of them is an equity share structure. And so the way this works is a private investor would bring 30 to 40 points of cash up front. So you could buy a house. Instead of a 95 LTV, you might do a 65 LTV loan. And then you do 30 or 40 points of cash. And there's no monthly payment. It's a loan. It's a second lien. There's no monthly payment. And then what you do is when you sell the home in the future, if you borrowed 30% cash from them on day one, they get 30% of your future appreciation.
Oh, wow.
And so what it does is it helps a person solve that math problem. You're getting a lower monthly payment that's 30, 40% lower.
Mm-hmm.
And then in the future, 10 years later, when you sell your house, maybe when you have more wealth, then you share some of that wealth. And so, there's pros and cons, but it gives one option to home buyers.
Well, it at least gives you the opportunity to get started. We have a builder in Fort Worth, Texas, who his mission, he does entry-level housing, and it's so cool because his houses are very simple, but it allows somebody that opportunity to come in. He's like, I want young people like me to be able to start generating their own wealth, because truly home ownership is the way to get started. So really having that opportunity to get in and get started and be building any kind of wealth is very valuable.
And there's such a huge connection to home ownership and wealth. The correlation to wealth in the United States to home ownership is a really tight correlation. It's almost impossible to become very wealthy if you don't own assets, including a home. So there's also huge other benefits to our society by home ownership. If you own a home, you can feel more connected to your community. I was a police officer in the Los Angeles riots when you felt the world was getting burned down. And if you own a business or if you own a home, you're going to be less likely to want to burn down your community if you own that business or home. So the emotional stability, in my Habitat days, when you see a family who gets their first home after renting their whole life, the children do better in school, their emotional health is higher, the emotional stability of the family is higher, the financial stability is higher. So there's a lot of just the fabric of our society becomes stronger through home ownership. It's not all like apple pie, let's sell homes. It's a very powerful impact to people, but also the mindset. If you own a home, you care about everything in your community. You care about the quality of schools. You care about quality of life. If you want to buy a home, but you're a renter today, but just that desire, you're going to work harder to save money and delay gratification to save money for a down payment. So saving for the dream. If you decide you can never afford to buy a home, people's mindsets change. Raising a family mindset might change. How you think about investing money. There's studies that show that people who think they can never buy a home are more likely to invest their money in more risky assets and have a different approach in how they view work and they view savings. So there's a huge impact to homeownership beyond just the typical ROI we think about.
I think it's interesting, and I was talking about this. I just did a podcast with the founder of Hope International and Homes for Hope, and it's amazing how there's so many times where we think about one issue and we only think about the issue, but we don't understand or always think about the magnitude or the ripple effect that it has. So I love what you're saying about home ownership isn't just about owning a home, because I'm very passionate, and I talk about this to our home builders all the time, that they're essential, particularly the private home builder, because they offer choice to people, and they give people an opportunity to buy a home where they're going to live life. But beyond that, what you're saying is it's huge. And having a passion for the community and having a passion for the way that you're raising your children and the schools and the environment that they're in, it makes it so much better. And big problems are solved locally. I've always believed that. And I don't know, the federal government's fantastic, but I don't believe that they're going to be the end all be all for all of us. Definitely not. Happens in small communities. When I was working in the schools, because I was a perpetual volunteer, my kids were super important to me when they were growing up, and I wanted to be involved in making sure their school was in good condition and that they had good support and that the kids were able to do all the things that they were able, was possible for them. And one of the initiatives that I wanted to try to get through is we live in the Chatfield community, and I thought it was really important to make sure that all the elementary schools that fed into Chatfield became a community, and that they worked with the middle school, and that the middle school worked with the high school. So one of the programs we did was a parents' night out type thing, and then we coordinated that with the elementary schools when they were doing their silent auction. So then the middle school would host all the elementary kids at the school, so the parents could have their silent auction, and then Chatfield would have some other kinds of events, and really make it. That's how you create change, and that's how you build stability in the community. And it all starts with home ownership, like you're saying, because they're all people who care about their community.
And you want to meet your neighbors, and you want to get to know your neighbors. If you're a renter, you're just temporary. You don't have that investment, that long-term view.
Yeah. So it's beautiful. So it's important to make sure that we're working and continually focusing on affordability. I know for our home builders, they're spending a lot of time focusing on that and trying to manage their costs so that they can maintain it, because obviously the market sets the price. And one of the things that the builders experienced in the last few years is that they weren't able to set the price at a price that the buyers could afford. And so there was a lot of incentives. But I'm just now finishing the study that we do every year, and I'm noticing that a lot of our builders were maintaining that 30% gross margin ratio. So based on their sales price and their cost of sales, they were maintaining that good relationship, and it's important to continue doing that. Are you seeing anything with your relationships or builders that you've talked to, or you've had experience observing the home building industry, that you think that home builders can do differently to help with the affordability issue?
I think it's important that as mortgage lenders, as home builders, as realtors, anybody who's in the real estate community, that we're all working together, because if we don't understand each other's challenges, like the solutions will be mostly local driven. Some will have some federal angles, but mostly local. But that's the key, is to just the awareness of what the challenges and issues are. So if I'm meeting with Congress members, I'll walk through examples of what builders, how much they have to spend before they can even break ground. Just the cost of, how all the little nickels and dimes and the permits can really add up to be a large amount. And we were just talking before, if there's a $60,000 cost just for permits to do a home for $400,000, well, guess what? That price of that home just went up by 15%. And that means your mortgage payment's 15% higher, your down payment's 15% higher. And a lot of communities, a lot of local governments have sort of tied their revenue stream to the housing market. And it's been great for them as home prices have grown over the last 20 years, since 2008 for sure. Yeah. It's been very profitable, or very strong revenue. But we have to be careful we don't overtax the process, because there's no free lunch. Every fee that gets added to the cost to build gets passed through to a home buyer and becomes part of the obstacle we have to now overcome. Absolutely. And it doesn't help if rates are rising at the same time home prices are rising.
Right. Yeah, because then it's like you just pricing how many, for every $1,000 that a house goes up, home price goes up, how many people, do you know that?
I don't remember the number, but it's
significant how many people just from $1,000 price increase.
Yeah. And if you just look at any community and say, what's the median price home? What percent of humans who live in that community can afford to buy the median price home? It's always very skewed to, the median income cannot buy the median price home.
Right.
And it just shows the math problem that people face. So that's, all of our efforts are, down payment, monthly payment, but also if we solve the math problem, that's a temporary solution to the immediate symptoms of the problem. But the main issue, and people in Congress do get this, both sides of the aisle do get it, that we need more supply. And people debate how much. Some say 3 million, some say it's 15 to 20 million. I think it's somewhere in between is probably the real number. But we need more supply to meet demand, and that'll help home prices become more stable and affordable. But the supply issue, it's the cost to build, and it's the regulatory cost and all the other just inherent cost to construct.
Well, one of the things we talked about, because the regulatory burden is significant. It's not just like, a little bit here and a little bit there. You talked about a $60,000 permit, and that's not it. I think it's NHB found that it's $131,000 on a $500,000 home, I think is the number. That's huge. That is a huge number. 26% of the home is all regulatory fees. Now, one thing is, I know a lot of people are like, oh, what is the federal government doing about this? But that's not a federal government thing, is it?
Those are almost local, county, city, or sometimes some state fees. Yeah. Almost all of that.
And I know that there is some effort to educate the federal government about this issue, correct?
Yes, and when we have these conversations, they'll hear the numbers, they'll hear the math, and they'll agree, like, how do we fix this? And then the question is like, well, how can we at the federal level fix it? So what they've talked about is trying to create incentives. Can you create like tax incentives at the federal level that could encourage states to do, make it more efficient to get permits and lower cost? I think as there's more and more focus, because historically in the past, people could, point fingers 85 different ways on why a home's expensive. But now that there's more and more awareness that it's the cost to build is a big part, and there's been so much focus on builders politically, both from the White House, from both sides of the aisle of Congress, and from the housing industry, of like, how do we support builders? How do we overcome these obstacles? As more people focus on this, it'll be more clear that it's not just one complaining and whining. It's like, this is real math. If these are real costs, there's no free lunch.
Right.
And if in that example, if you're adding 27% to the cost of something, that goes into the price, it goes into the mortgage payment.
Yep.
And that's, if you want to lower costs, we have to find a more efficient way to build and still have thoughtful zoning and processes, but remove unnecessary costs.
Yeah, I agree. And I think, when we're looking at, if you're looking at 70% of the home is the cost of sales, and on average across the country, it's around 20%, a little less than 20% for land, and then right about 50% for materials, labor and materials to build a home. And in that number, you have 26% of that's more than the cost of the land.
It's a huge part of the math. It's huge.
Yeah, I don't know how we solve that problem, but I'm hoping, and I think part of it is, home builders, but becoming more involved in their local municipalities too, and raising their hand and saying, well, that $1,000, we talked about it, the $1,000 fee here and the $25 fee here and the 2% fee here and this percent, all of it is very little, but pennies add up.
Very much.
Just like saving pennies adds up, so does spending pennies. And so it's been part of the problem is that I don't think anybody realizes how much their little bit is impacting the overall pricing of affordability. And
I think the more we talk about it and highlight and just show real examples, and people can see these examples aren't some out of character, it is a typical example, and it builds the credibility and it builds the awareness. I think that's the key.
Yeah.
And just connecting the dots. Hey, if we're going to add 10,000 or 25,000 or 65,000 to the cost, it flows through. Here's how it impacts the borrower. If we can lower costs by $10,000 or $20,000, and people in Congress will say, well, okay, if we lower it, will builders really lower their prices? And the answer is yes. It's a competitive market.
Yes.
Does it mean it's directly one for one the next minute, like a line item? No, but it's a competitive market. It's supply, it's demand. That's where the price of housing is set. And if you can lower the cost to do something in a competitive market, the answer is confidently yes. It'll pass through.
Absolutely. Well, and you see it happening, right? Because why are incentives so high right now? If home builders aren't going to pass along the savings to the buyer,
yes,
of course they are, because the market sets the price every single time. We'll have builders come to us and they'll be like, yeah, I accomplished my goal of 30% gross profit because I upped the price of my home. And I'm like, no, that's not how that works. You get the price that the market will bear first, then you deduct your costs, and that's how you get to your profit. But you have to understand, what is the price the market will bear? And obviously the market wasn't bearing the prices that have been out there because of the supply that was out there, because of the the pricing. I mean, it just wasn't feasible. So that's why we have all of the discounting that has been happening. So yeah, the market will tell you. I always told my kids, if you want something to change, vote with your pocketbook. That's the best way. When you vote with your checkbook, things change.
Markets are very powerful forces.
Yeah.
Very much.
Tell me a little bit about interest rates, because that's a big thing too.
Yeah.
That's really impacting affordability. It's impacting mortgages, impacting the ability for people to get into housing.
I think where interest rates are literally today on today's rate sheets are probably the highest they've been all year. The main reason right now is oil. The conflict in the Persian Gulf is driving up oil prices. Long-term interest rates are based on two primary forces. One is where bond investors, like 10-year treasury bond buyer investors, think inflation is going to be in the future. If you're going to own a mortgage or own a 10-year treasury bond, where inflation is today is important, but more important to you is over the next 10 years where inflation is going to be. And it tells you what you're going to really earn in your investment. If you think inflation is going to be 2% for the next 10 years and you have a 4.5 coupon treasury, then you're making 2.5% above inflation. That's your net return. That's maybe where you want to be, and that's a good place. But inflation going higher is like a rising tide. If inflation goes up 50 or 100 basis points more than we thought it was going to be, then every interest rate on the planet lifts accordingly. So what's happening now is as oil prices go higher, it's not just the price of the pump we pay for gas. Like everything we're wearing, everything on our table probably has petroleum of some type in some part of something. The cost to produce goods is driven by petroleum. The cost for farmers to produce food, that's a big part of the cost of operating a farm. So when oil prices go up, it really raises a lot of the inflation indexes or calculations. A lot of those go up. So the real question is, as far as where rates are going to go, is how does this Gulf situation go long term? Not just the next 2-3 months, but where are we 12 months from now? I'm optimistic. I think this is a short-term spike in rates. Oil prices were this morning, right before I came in, were in the 90-ish, 100, depending. West Texas Intermediate is what we should look at in the United States because that's what drives our prices here. Brent crude's more for international other countries who are buying oil, but because we produce our own oil here, our prices will be driven more by West Texas Intermediate prices, which were just below 100 this morning. But my view is, I think this is a shorter term pressure for a lot of reasons. I think just sort of logically, I don't think this crisis will stay at this level for many months. It has to break one way or the other for different reasons. But I think it's a short-term impact. But before oil, if you take that out of the equation, we saw some good news in the inflation reports before the flare-up in the fighting in the Persian Gulf. And the indications are that some of the other elements in the economy that drive inflation seem to be coming down. So if you took oil out of the equation, the inflation picture in the last 4 months has looked like it's dropping. And so that, back to the rising tide, would indicate rates could be going lower. If there wasn't the oil price issue right now, I think rates would be more at the low of the year than the high today. Meaning rates in like the low 6s, high 5s might be possible. In
kind of what they were predicting.
Right. The other big factor that drives interest rates, long-term interest rates, is the federal budget deficit. If we, as a country, overspend our credit card by $1 trillion, let's say, and our deficit grows by $1 trillion, we have to pay for that $1 trillion by issuing treasury bonds. So if we issue $1 trillion more of U.S. treasury bonds into the bond market, we flood the market with bonds. That pushes the value of every bond down, and it pushes the rates up. So one of the best things we can do as a country is reduce the federal budget deficit. At the end of the day, supply and demand drive the price of almost anything, including mortgage rates. So if we reduce the deficit by $1 trillion, that reduces treasury bonds in the market by $1 trillion. That reduces the supply, which makes the price go up and rates go down. So a smaller budget deficit is our best hope we could have for long-term interest rates combined with lower inflation. So the ideal scenario would be low inflation, a shrinking deficit, And you get there by either having more revenue coming in the door or less expenses, government spending out the back door. So there's been a lot of focus on government spending. If that can reduce or result in lower spending, at the same time revenues increase, let's say the stock market's continues to have record highs, personal, private citizens, as well as entities and businesses, if they're making capital gains in the stock market, that creates revenue to the IRS. So if the revenue side can come in from a growing economy and a strong stock market, that creates revenue. If we can cut spending on the backside, that helps that side of the equation. If the net result is a shrinking deficit, that would be really good news for long-term mortgage rates.
Wow. It's one of those things where the one thing impacts so many different pieces of the puzzle.
Very much.
I think it's fascinating. And I love, my dad was an economist. That's what he studied as his bachelor's degree. And that's where he started with the NAHB. So he's always been fascinated with economics. And I've always like, did anybody take economics who's running this country? Sometimes I wonder.
It's funny. I met with one of the Federal Reserve governors. He was doing a speech for a group one time, and he says, I'm an economist, and every word out of my mouth is supply and demand. And I thought, I wish they told me that in the beginning, because I had to learn all this stuff in economics, and all you really needed to know is supply and demand. Everything else doesn't really matter. It's just supply and demand.
Well, exactly. I mean, you look at the graph, and it just happens. It's magic. Yeah. One thing impacts the other. If you have too much, then you don't have the power to raise the price. You kind of like, because you want to get rid of it, just like what happened with all of the sitting inventory. The builders were wanting to get rid of all of that sitting inventory, so they didn't have pricing power, so prices had to drop. Once the inventory stabilizes, then the prices can stabilize a little bit more, and then the demand will kind of pick up with that because there's not as much supply, and they'll be like, ooh, I actually want that. But when there's thousands of them, they have too many to choose from, and they know I'm going to get a better price if I wait. Yep. So you stabilize the market by looking at supply and demand, and it's amazing how those things work.
That's where we are today. Interest rates, supply and demand of oil is affecting inflation, and supply and demand for bonds affects mortgage rates. So supply and demand.
Wow.
So simple.
So simple.
So simple.
Very simple, I know. And everybody makes economics so challenging. You know, speaking of economics, and you seem to have a pulse on some of those things, and as a home builder, what are some things that they should be keeping an eye on as far as how, just to see the stabilization in the market? Do you have like things that you check for as being in mortgage that, I need to be keeping an eye on these things because I know that these things will affect the market? What are some things that you keep your eyes on?
Probably the single thing that I would recommend looking at every day is the 10-year Treasury bond. Think of mortgage rates as almost always priced as spread to the 10-year Treasury. So whichever good or bad direction that goes every day, mortgage rates almost follow. Not always exactly the same amount every day for some different reasons, but over time, there's a very strong correlation. So as far as things to watch, the 10-year Treasury bond would be a great bellwether for where rates are going. And then as far as other factors that drive rates, it's the supply and demand factor. So anything in the economy, historically, anything that's bad economic news historically means that rates usually go lower, and in a booming economy, rates usually go higher. So historically, if the economy is kind of weakening, softening, that might mean rates go lower. You could have a booming economy and not have rates go higher as long as inflation doesn't get out of whack. The hope there is that as businesses become more efficient, and AI might be hopefully a big part of that, if businesses can scale up in a booming economy without having to raise their prices because they don't have the capacity to take on more orders without their costs going up. If they can have higher business volume without their costs going up, then you could have a booming economy without inflation. Normally, basic Econ 101 is booming economy means higher inflation, higher interest rates, and recession means lower rates. But what's interesting is, I think an important point today is there's a lot of people, and this is on social media, like, hey, there's a recession coming, you should wait to buy a house.
Well, that's been being said since 2022.
Right.
Just saying.
So
actually since 2020, because we were going to have like a W, and then we're going to have a V, and all kinds of an X and a Y. I'm not quite sure, but they've been saying that since 2020.
So if anybody says they know a person who predicts recessions and blah, 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 guess what? A recession's always coming. There's never a time where one's not on the horizon.
Right.
6 months away, 6 years, nobody knows, but one's always coming. It's a normal part of the cycle. What's interesting is that if you look at home prices and recessions, except for 2008, all the other recessions in the last 60, 80 years, home prices barely took a blink.
Mm-hmm.
So if you're waiting for the next recession to think that you're going to get a drop in home prices and better to wait, you could be waiting a long time for the recession. Correct. In the meantime, home prices keep rising. Or you wait and it happens, but guess what? Home prices keep going up.
Yeah.
It's very possible, and maybe even likely, that home prices keep going up in a recession, especially if we still have a lack of supply of homes compared to demand. So social media, waiting for a wave of foreclosures, that's sort of related to that. That's also, I go in the fake news. Yes, if there's a recession, yes, if unemployment goes up and people don't have jobs, that foreclosures will go up. But most people today have a lot of equity in their homes. There will be people who just bought a house for zero down and they have no equity and they'll walk away. But there will not be a wave of foreclosures.
Like there was in 2008 through 2010, yeah.
There will be an increase. For sure there will be an increase. But most homeowners, if they lose their job, they can get forbearance. They got 6 months, 12 months, 18 months to live for free in their home and try to find a job. If they can't get a job after 18 months, then probably shouldn't maybe be in that home.
Right.
And so there will be foreclosures. There will be REOs, but it will not be a giant wave like 2008. And if you're waiting for that because you think it's going to depress home prices, you can buy homes really cheap, you could be waiting a long time and they may never go down.
Yeah.
Even though the foreclosures could go up, they could get sold by owner through realtors on the market and get back a little bit of their equity. So there won't be a giant wave. So I wouldn't.
Well, even with what, with talking with home builders, they've always been very cognizant, as interest rates went up, they knew they had to bring the price of their home down in order to make it affordable. Right. But they were very cognizant about how that would impact their previous homeowners, because they knew that if they were selling the same home at a lower price than it was sold 2 years prior to, that impacts the former homeowners. So there was a lot of intentionality of not lowering prices because of the impact that it has backwards. Right. Because then we have the situation in 2008 where people had homes that were worth less than they owed on their home. Right. And so that was some of the conversations that we were having in our builder group meetings. They're like, I know I'm moving into a new phase, and they were intentionally creating new product, but they were being very cognizant of the home pricing for that specific reason.
And the challenge for homeowners too, or home buyers today as well, is if they're looking at the math problem and they see a rate quote today that's probably in the sevens almost, or actually in the sevens, some rates are, they have this thought, well, gee, should I wait till rates get normal? What I would say if someone says that, I would say, first of all, what's normal? If you look at Freddie Mac has a rate survey for 60 years. The average rate over 60 years is 7.7. And so if someone's looking at 7% saying, I want to wait till they're normal, like they could go lower in the next few months, or they could go higher. Yeah. It's about a 50-50 which way they go. So if you're waiting for a normal rate, you're on the good side of average already. But to me, the most important part is if you could buy the house you really want, and you love this house, you want to live there for many years, at least own it for many years, and you're not a speculator trying to flip, but you're going to own it and live there. If you can afford the payment, even though you don't love it, if you can afford it at 7%, buy it at 7%, and think of it as the cap. That's the max you'll pay the rest of your life. But every time rates go lower, you refinance. Most lenders will do refinances for very low or zero cost. So it's just your time and energy to give them the documents. It's a pretty easy process to do a rate term refinance. And then every time rates drop the rest of your life, you just lower your rate. It's like a ratchet wrench that only goes down. But the problem is if you wait for rates to go lower, home prices could go higher. So, 3 years later, rates are lower, but 3 years of home price increases took equity out. So if you buy today, you've locked in your rate for the rest of your life. And doesn't mean home prices automatically go up every year, but there's never been a point in U.S. history, if you look at home prices, where 10 years later prices weren't higher 10 years later on a national basis.
Right.
So it doesn't mean 1 year later it can be higher, but if you're going to be there long term and you're not a short-term flipper and you own it for 10 years, likely home prices are higher. Even if they're not, you've been amortizing principal about 1% a year, creating equity that way.
Mm-hmm.
And if rates zig and zag and recessions and booms and busts, all these things happen in the economy, good and bad. Every time rates drop, just refinance.
Yep.
And if you're renting, you can't do that. To me, it's like you're playing a roulette game in Las Vegas and the odds are in your favor. You have more ways to win than to lose. But if you're on the sidelines watching, you need to be in the game. And
rent goes up every month or every year.
Yes.
My daughter's like, oh, rent just went up a couple $100.
And
my salary did not.
Well, and there's a few times rent might go down, but
yeah.
Historically rent, if you look at a 10-year run, rents are almost higher 10 years later.
Mm-hmm.
And so you're saving money in the rent, you control your destiny. Let's say you love where you live. I had a lot of friends who rented a great place. I used to live in Redondo Beach, and people had this wonderful place right in the beach. And they became like best neighbors. We'd see them every day, going out for walks. And all of a sudden they're getting booted out because their rent went up. And I'm like, they sold their house and then they they got a rental, and they loved where they lived, but then they had to move. So control your own destiny and move when you want to move, not when your landlord raises your rent.
Yeah, that's incredible. That's a good viewpoint, definitely. I think we're coming close to our time together. I did have a question for you. Tell me, out of our conversation today, what is one thing that you would hope that our guests take away from it?
The importance of advocacy. Mm-hmm. I think that if you're, as a builder, as a home buyer, home seller, wherever you are in the system, if there's things you see that are frustrations and you're thinking, don't people know about this? Or like speak up, share, educate, because there's people who want to solve problems and they don't always understand the issues. And if you can bring the issues to their attention and bring the solutions and not just bring the complaints, but here's how we can solve this and how we can solve that, things can happen. There are people who want to find solutions. Politically, both sides of the aisle. If you're up for a re-election and you're in Congress, you want to find something that helps improve affordability. Doesn't matter which side of the aisle you're on. And if good ideas come to the table and they're presented either at the federal level or at the state levels, solutions will occur.
Yeah. Well, and I think be involved in the solution as well. We might present ideas, but don't just present ideas and be like, peace out, I'm done.
Right.
Because the problem is, and I can tell you from being a volunteer in the schools, is that there's a lot of great ideas, but there's no human power behind it. And so if you want to see some change happen, find a way to participate in that change as well. Even if you're only donating a couple hours a week, a couple hours a month, any time to help solve a problem, not only with idea generation, but with giving manpower or donations of any kind, is super helpful. But I feel like manpower is the one thing that we're missing to make true change happen. And I don't know if you...
Completely agree. People sometimes joke Washington, D.C. is where good ideas go to die. So just the good idea itself doesn't solve the problem. You have a good idea, but look, okay, how do we make this actually go into reality? How do we execute? What steps have to happen? Mm-hmm. And so it's thinking through those, finding and being part of it. If it takes time, it takes energy, it takes money, put those efforts into it and to work in groups. I mean, at the end of the day, builders and mortgage lenders and realtors, we're all in the same ecosystem. And if we can find ways to work and understand each other's positions and how each other's issues impact us, mm-hmm. and we can work together and collaborate. So if there's issues where the builders have some challenge on some regulation or some issue, whatever it might be, realtors need to own the issue. Mortgage lenders need to own the issue. All of us in the system need to own the issue and be there supporting and adding credibility, mm-hmm. and adding facts to the debate so that decision makers get a clear picture.
Yep. Absolutely. And even the home buyers need to understand that. Because I think sometimes they're like, oh, I'm just going to believe what they tell us. And it's all the builders trying to be greedy. They're trying to be greedy and make all kinds of money. Tell you what, not all builders make all that money that you think they make, because it's very expensive and really risky to run a home building
incredible
company.
Risks, 100%.
Yeah. Well, thank you so much for being with me today.
It was nice to be here.
It
Thank
was
you for having me.
Great conversation, always. Our conversation we had at dinner that one night was inspiring for this conversation as well. So we covered so many things: being involved in your community, home ownership is essential, understanding what the problems are, making sure that you share that knowledge, and being involved. I think we covered it all. And we even talked about some of the little issues in between.
Yeah, this was a very fun discussion. Hopefully worthwhile.
I think so. Thank you so much.
Thanks, Henry.
And thank you all for joining us today. We appreciated having you here, and we hope to see you at our next Builder of Choice Insights.
Thank you.
Thanks for watching or listening. Give us a like and leave a comment. And if you thought of somebody, be sure to send them a link so they can listen too. As always, we'd love to hear your feedback. Is there a specific topic or special guest that you want to hear about? Let us know. Did you like what you heard? Then I've got great news for you. You can listen to this episode along with many more at Builder of Choice Insights, where I talk with industry experts on crucial concepts that help builders become the builder of choice. If you don't want to miss this next episode, then be sure to turn on your notifications, hit that like button, and subscribe.